Thank you for joining me. I'm Alex, and I want to have a look at Cloudflare to see whether or not they're a bargain right now, because they're basically in a whole sector that should be largely unaffected by the current situation. And obviously, the stock market as a whole is down pretty far, so there's a lot of bargains to be had. What they do is cloud computing and security for cloud computing. There's a lot of companies using Cloudflare for a lot of things, actually. But as a cloud computing provider, they can provide a lot of things, and they're needed for a lot of things for companies that aren't affected by even a recession, because obviously websites still need to run and websites are still making money, and if people are staying home, websites might make more money. So current price just under $24, which gives them a market cap of $7.2 billion. Obviously down 8.5% is not great, but NASDAQ as a whole down 3.5%, obviously not great either. So that is not too far out of line of what the whole market was doing yesterday. So dividend is zero. I don't expect that to change in the next decade or so, so obviously not worth looking at. Revenue $287 million, earnings negative $106 million, and that gives them PE of negative 36. Forward PE is not listed either, which means that they're likely not going to be profitable next year either. So revenue has been growing at a 50%-ish pace for the past 4 years, which is pretty amazing. If they can continue that for a while, then obviously it will be very easy to eventually make a profit. Right now, obviously, they're not focused on a profit. They're just focused on growing their business, which is generally something that I would do as well. Total assets, $830 million. Total liabilities, $105 million, which gives them total stockholders' equity of $726 million. Not $726. That is just weird. Anyway, they did that mostly by issuing new shares, which is kind of a problem for me for several reasons. But obviously, things going in the right direction on pretty much all fronts, maybe except for the earnings. So overall, I would say that because things are progressing nicely and in the right direction, this might actually be very helpful. So the reissuing of stock is a problem for me, because you cannot be sure that shares that you buy today are going to not be further diluted by issuing new shares. And so you don't exactly know what you're going to get. And that's something that I don't really want to deal with. So I won't be buying this company. And as far as other investors go, value investors obviously are out, because balance sheet, not great. Getting there though. So right now, the assets to liabilities ratio is pretty amazing, but there is not a whole lot there yet. Earnings negative, no dividend, market cap of about 10 times of the stockholders' equity. So overall, I would say value investors are just going to have to be out. Dividend investors, obviously, where there's no dividend investor, and so they're out too. For a growth investor, if you believe in this company, and it's pretty easy to believe in this company, because growing at a rate of 50% year over year for 4 years is pretty amazing. So there's definitely something there for a growth investor, and they're probably going to continue that for a few years. So if you don't believe that they're going to be reissuing shares, and or if you believe that they are making really good decisions with the money that they get from that, I think this is worth investing in. I still wouldn't really go far above a speculative investment here. Definitely do diversify well, but I think that it's worth to have a look and see what the risk factors are, and whether or not you think that they're going to be around in 5 to 10 years. That's it from me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.